Introduction. Greetings, dear viewers. Today we are going to look at one of the most significant events in the history of the financial world, the 2001 stock market crash. For several years prior, the US economy had been on the rise, but in 2001, the stock market began to fall, leading to mass panic and serious consequences for the economy as a whole. In this video, we will explore the key causes of the market crash, its consequences, and the lessons that have been learned from this experience. Get ready for an exciting and educational journey through the history of financial markets. The stock market crash of 2001 was one of the most serious events in the history of the financial world that affected the lives of millions of people. This collapse resulted in significant losses for investors and companies, and also triggered an economic downturn and recession in the US and around the world. Understanding the causes and consequences of the 2001 stock market crash can help us avoid similar mistakes in the future and make better investment decisions. In addition, knowing the history of financial crises can help us understand how the economy functions as a whole and how its various components interact with each other. That is why the topic of the 2001 stock market crash is so important and relevant in our time, and why we recommend that you study it in more detail. What is a financial market? The stock market is a market in which securities such as stocks, bonds, and other financial instruments are traded. These securities represent ownership interests in companies and government organizations, as well as liabilities to creditors. The stock market is a place where investors can buy or sell these securities and thereby invest their money in companies and states. The stock market is one of the most important components of the financial system, which plays a key role in the development of the economy and the financial sector. It is also an indicator of the health of the economy as a whole and can reflect investors' expectations about future economic growth and company earnings. The stock market plays an important role in the economy as it provides access to capital for companies and government organizations. Companies can sell their shares on the stock market to raise additional capital and finance their growth and development. This can help create new jobs, develop new products and services, expand business, and so on. In addition, the stock market can serve as an indicator of the health of the economy, as it reflects investors' expectations about future economic growth and company earnings. If investors expect the economy to grow, then they will tend to invest more money in the stock market, which can drive up stock prices and increase overall consumption in the economy. In this way, the stock market can have a positive impact on the economy by providing companies with access to capital, boosting the economy and stimulating consumption. What happened in 2001? In the late 1990s, the US economy was in a period of rapid growth, and investors were very optimistic about the prospects of companies and the market as a whole. By this time, many technology companies, including major players such as Microsoft, Cisco, and Intel, had become very successful and popular with investors. However, in early 2000, some negative events began to occur, which became harbingers of a stock market crash. In January 2001, Lucent Technologies posted a large loss for the previous quarter, causing the company's share price to fall and causing alarm among investors. Then in February of the same year, Nortel Networks, which was one of the leaders in the telecommunications market, also announced a large loss and cut its forecasts for the future. This caused a further decline in technology stock prices and the general market. In March 2001, the largest technology index, Nasdaq, famously fell by 13% in one day. This happened after Cisco announced a drop in profits and cut its forecasts for the future. This caused panic among investors who began to sell shares en masse, causing prices to fall even further. Of course, this is only a brief description of the key events that led to the stock market crash in 2001. In the future, many experts called the cause of the market collapse not only problems in the technology sector, but also more general problems in the economy, such as asset revaluation and reduced consumer demand. The stock market crash of 2001 was caused by a number of factors, including asset repricing, declining demand, and competition between companies. One of the main factors that led to the collapse of the market was the revaluation of assets, especially in the technology sector. At a time when the market was in a marked upswing, many companies became too dependent on expected future revenue growth and exaggerated their expectations. When growth began to slow and earnings fell short of expectations, many investors began to sell shares en masse, which caused prices to fall. Another factor that contributed to the collapse of the market was the decline in consumer demand. In early 2000, the U.S. economy slowed down and consumers became less willing to consume, which led to a drop in the profits of many companies and alarmed investors. In addition, there was fierce competition in the technology industry, which led to overproduction and lower prices. Many companies have tried to gain market share by lowering the prices of their products, which has increased competition and reduced profits. Thus, the 2001 stock market crash was caused by several factors, including asset repricing, declining demand, and competition between companies. Consequences of the market crash. The stock market crash of 2001 had serious consequences for investors, companies, and the economy as a whole. Many investors lost significant amounts of money as stock prices plummeted. Many investors who were involved in the technology sector lost huge amounts of money as this sector was the most affected. Companies also suffered significant losses as a result of the market crash. Many companies have been forced to cut costs and lay off employees to cope with falling profits. Some companies were forced to stop their activities altogether because of the market collapse. Moreover, some companies have tried to understate their financial statements in order to preserve the value of their shares, with more serious consequences. The market crash also had a major impact on the economy as a whole. The decline in stock prices led to a reduction in the wealth of investors, which reduced their consumer spending and confidence in the economy as a whole. Companies that began to cut costs and lay off employees increased unemployment and worsened economic growth. Thus, the stock market crash of 2001 had a serious impact on the economy as a whole, leading to a deterioration in business activity and an increase in unemployment. After the stock market crash of 2001, the economy gradually recovered, but this process took several years. Companies have begun cutting costs and laying off employees to cope with falling profits. However, over time, the economy recovered and began to grow. The U.S. Federal Reserve also helped spur economic growth by cutting interest rates to historically low levels. This contributed to the increase in borrowing for businesses and individual consumers, which again became a stimulus for the growth of the economy. Important lessons were learned from the 2001 stock market crash. First, many investors have realized the need to diversify their investment portfolios and spread risk in order to reduce the risk of loss. Second, companies have realized the importance of maintaining honest and accurate financial statements to maintain investor confidence and maintain market stability. Third, the economy has realized the need for greater control over the financial market and more accurate forecasting of economic crises. Overall, the 2001 market crash was a hard test for the economy and investors, but important lessons were learned from it that helped the economy cope with the effects of the crisis and improve its resilience to future crises. In conclusion, the stock market crash of 2001 was a severe test for the global economy. Many companies and investors lost a lot of money, and the U.S. economy went into recession. However, even after such difficulties, the stock market recovered and became stronger and more resilient. We looked at the key causes of the market crash, its implications for investors, companies, and the economy as a whole, as well as the lessons learned from this experience. I hope this information has been helpful to you and will help you better understand how the stock market works, its risks and opportunities. Be careful when investing and remember to learn from mistakes in order to achieve financial stability and success in the future. Thanks for watching this video. If you want to learn more about financial stability and investing, I can recommend the following resources: financial magazines, blogs, books, and financial advisors. You can also continue to study topics related to the stock market, such as economics, politics, and technical analysis, to gain a better understanding of how the market works. As future topics, consider other market crashes such as 1929 or 2008, or other topics related to investing in finance, such as various investment strategies, financial management at home, or the basics of taxation when investing. If you have any specific topics you would like to discuss, please let me know and I will try to help you with that.